back in the day when Draghi was ECB president, he spent a lot of time, and I remember every single press conference almost, he would stress the need for structural reforms in Eurozone economies. And here he is, he's now the Prime Minister of Italy, one of the countries that you could argue is in most need of structural reforms out of every country in the Eurozone. He's basically being handed a 200 billion euro check and has announced a whole slew of measures that they're planning to use the money on. How much of a lasting impact do you think this is really going to have on the Italian economy over the medium term?
Well, we think it's a great opportunity for Italy. The recovery fund is large in size. So as you said, 220 billion in total, that's around 12% of GDP. The plan is to spend this money on investment that tends to have high multipliers and so tends to have more sustained effects on growth. And then it's also spread over a number of years, which should make it helpful for Italy to support the recovery, not just in the near term, but also over subsequent years. So we think it should have a very significant effect on the Italian outlook. But of course, this money also needs to be spent efficiently. It needs to be timely, and it needs to be executed in the right way. And I think that's really where the focus should be now.
Well, like every other country in the Eurozone or over the world, Italy has had to borrow substantially to support the cyclical response and of course, some more of the longer term responses as well. The fiscal deficit is set to reach around 12% of GDP for this year. Debt to GDP numbers will rise to 160%. In your notes, you say that that is the second highest level ever for the Italian nation. And of course, this comes at a time when Eurozone is still facing record low or very close to record low interest rates. So that helps the country, of course, continue to financing itself. But again, Prime Minister Draghi knows better than anyone else that all of this is a function of prevailing interest rates. Do you think that Italy will manage to bring down those debt ratios by the time the ECB start thinking about moving interest rates higher again? Or are they permanently going to be stuck with this huge overhang of debt as a function of the pandemic?
Well, it is, of course, a huge amount of debt, almost 160% of GDP, and it clearly comes with medium-term sustainability risks. But we actually think that the hurdle for sovereign stress in the near term is pretty high because, first of all, we expect the Italian economy to rebound pretty sharply as the reopening begins. And we think that's going to be the case also elsewhere in Europe. Secondly, there's still a lot of support from EU institutions for Italy and for Southern Europe. That's the ECB's PEP, which we think will run until June 2022. And then, of course, as we just said, the recovery fund. And then lastly, we think the political situation in Italy is quite a lot more stable than it has been in recent years. So when you put that together, we do think there's a fairly high hurdle for near-term sovereign stress. But of course, it's a long road for Italy ahead in reducing that debt to more normal levels.